Subscribe to our YouTube channel and press the bell icon to get the latest updates.
Hello friends, this is Vijay Bamvani. I hope my videos are helping you become better traders and you're getting higher return on investments on your trades. Friends, in this video, I want to touch upon a very critical topic. I would call it super critical because it involves not just commodity traders but also equity traders alike. Recently, I recorded a video asking you whether you should, I'm trying to answer your question, whether you should be buying commodity-based stocks. Now, in this video, I want to touch upon the possibility that a big bull market that many people were expecting may just be dying, if not dead already, at least for now, till there is another unforeseen crisis like the Ukraine war. My veteran investors, traders, and followers on social media, on YouTube, etc., will remember that I have been very openly debunking the theory of a supercycle in industrial metals. I have been telling you time and again that this rally in metal prices is powered by nothing but rampant printing of unbacked currency, which has triggered inflation, and inflation is nothing but the cost of raw material prices jumping through the roof, and raw materials are industrial metals. Now, there is this theory that I have since I practice a 360-degree worldview, and I want to share my logic with you as to why I think that the super cycle existed only in the traders' minds and not in the marketplace. You see, when rampant currency was printed, that money had to find itself some place to get invested in so that it could earn a profit. That's the basic tenet of money. It must be deployed somewhere profitably and get a rate of return. Remember how lumber, which is wood, nothing but wood, when you cut a tree and put it to a sawmill where it is shaped into logs, it's purely wood. Remember how lumber went up 6 times. Remember how nickel has jumped to, aluminium has jumped to 3 times. Remember how nickel has put on 70% in one single trading session after the Ukraine war was announced. These are not natural movements. Alright? And this is money purely seeking some avenue to get itself invested in to earn returns. The difference between commodities and equities is that in equities, the supply, which is the number of shares that you can buy, is always limited. The paid up capital is always predetermined. It does not expand or contract every day. In commodities, it's a different ball game altogether. If a miner sees that the metal that company mines, for example, say iron ore, if the price is doubling and tripling, he'd say, hey, I don't think this price is going to stick around there for this long. Let me dig deeper into the earth and get more iron ore out. Which means that in commodities, both supply and demand are dynamic. It is easier to rig up equity prices rather than commodity prices. Do remember, if you are a veteran trader, how before the global financial crisis hit us, in the month of April and May 2008, you were hearing the same old stuff that you're hearing about crude oil and natural gas now. Oh, crude oil is going to go to 200. No, the other guy would say, no, I think it's going to go to $250 a barrel. And some people even ventured out to $300 a barrel. This was April, May 2008. If you check your charts on any free trading charting website, you'll realize in less than 6 short months, crude had collapsed. I can only call it collapsed because it was at a peak of $147 per barrel. In less than 6 months, it had collapsed to less than $45 a barrel. Welcome to the world of commodities. So commodities are basically susceptible to 2 phases. One is countercyclicality, where the asset price is moving in the opposite direction of the real economy. If you see what happened commodity prices jumped through the roof immediately after the lockdowns were announced worldwide in end of March 2020. Factories are shut, shops are shut, but commodity prices are going higher. Do you think consumption led it up? No, it was speculation. Now this is countercyclicality. As soon as countercyclicality runs out of steam, which it invariably does between 24 to 30 months, procyclicality steps in. Procyclicality is when asset prices and the real economy are coming closer and closer till they finally move in sync with each other. And the economy is taking its own sweet time. Do remember the RBI report which says India will take more than a decade to completely recover from the impact of COVID. Similarly, other countries are also going to take a long time to recover. So it's not consumption that led metal prices higher, it was rampant speculation. Now, the chartical aspect of why I think the supercycle theory was nothing but gobbledygook. I have similar views about oil and gas, but that's a subject of a separate video. I have a lot of requests from my viewers as to why I'm not making a video on oil and gas, because I stuck my neck out and I said I don't expect $100 per barrel of WTI to come, and even if it does come, it will be more of a photo opportunity rather than a sustained trade. But it was the Ukraine war which has added 25-30% sheen and shine to the price, which I don't think will sustain. But that's, like I said, subject matter of another video. Now, let's take a look at the classic Dow theory. Any reasonably good technician will tell you that when asset prices have fallen more than 20% or even 20% from its peak, it is deemed to be in a bear market. Take a look at the chart of aluminium on your screen. It's fallen more than 26% from its recent peak. For that matter, take a look at the chart of copper. Copper is known as the tin roof of the economy, or Dr. Copper. It is the best barometer for what industrial activity is worldwide. If the real economy is doing so well, why is Dr. Copper heading towards a decline of 20% from its peak? And do remember, aluminium has been declining slowly and steadily. If you see the percentage price decline in copper, it is far more sharper. The absolute fall in percentage, or maybe in percentage terms, is lesser, but it is more rapid. The worst of them all is the price chart of zinc. It's collapsed 15% in less than a fortnight. I'm getting a lot of WhatsApp messages and inbox messages on my social media accounts. Hey Vijay, I was holding longs in zinc and it's fallen in double digits in just 1 day of gap down open. What do? I tell them, look, I've been telling you guys, I don't believe in the supercycle theory. This is not consumption based. This is rampant speculation and easy money based bull market. I did say in my videos that I do believe a bull market is on, but a supercycle theory where the buyer is banging on the door of the seller doesn't exist. Most of these metals are mined in Latin American countries which are up to here in dollar denominated debt. And they've also been ravaged by the COVID-19 pandemic. They have spent a lot of helicopter money and they need to raise cash levels. How do they raise cash? What will they sell? Their primary assets are natural resources. So they are going to dig deeper into the ground and sell more and more base metals which are found in their countries. As the old saying goes, the cure for high commodity prices is high commodity prices. This is something that many of my young friends who are inexperienced in the commodity space did not remember before they actually made some pretty unkind comments on both my social media accounts and in the comments in my YouTube videos. Learn to be patient and read every cycle for what it is. Procyclicality, in my humble opinion, has already set in, which is why You're seeing, like I said in my very recent video in whether you should be buying commodity stocks, I said do not buy the stocks of those companies which are mining commodities, because the commodity is a finished product. The price of its finished product is falling, so the share price of that company will also fall. You are better off in buying those commodity related stocks in which the raw material is that commodity, because the raw material is getting cheaper, the company's profitability will go up. And I remember telling you, split your money into 4 or 5 tranches and deploy only one tranche right now. So maybe 20 to 25% of your money should be going into metal stocks, only that company which consumes the metal, not the one that produces it from its mines. Be very, very particular about how you think, because that's what my 360-degree worldview is all about. I thank you for your patience in watching my video. Till we meet again in my next, this is Vijay Bambwani signing off for now, but not before reminding you to click like on this video if you liked what you saw. In the comment section, good, bad or ugly, I love to hear from you and your feedback. And please help me reach out to fellow like-minded investors and traders who are looking for data-backed, rationale-based trading and investment conversations by referring my video to your family and friends. Take care. Have a very, very profitable day. Bye-bye for now.
Our new research uncovers some shocking truths behind today's hottest investment opportunity, electric vehicles. Don't invest your money in EV stocks before seeing our research. Click here to sign up for our special event to know it all for free.